We appreciate you joining us. As always, we have a full presentation today, so let's get started. First, I would like to introduce the team, starting with Aigul Zumasheva, our Administrative Coordinator, Paula Miller, Chief Administrative Officer, Kevin Fix, Senior Financial Advisor, Milt Fullen, Senior Financial Advisor, Justin Seidenwan, Associate Financial Advisor, and myself, Brianna Stein, Associate Financial Advisor. Before we dive into the material, I would just like to mention a few administrative items. First, you should be able to adjust the scale of your PowerPoint presentation to make it bigger if necessary by hovering your cursor around the edges of your slides. Also, we will provide everyone participating with a copy of this presentation, including some reference material that we use to put it together. Most of you know that we have pivoted to a virtual environment since the virus showed up in March. However, the office is still open and our daily operations continue to move smoothly thanks to Aigul. If you have a need to drop off materials or meet with someone in person, we can accommodate that on a limited basis while still maintaining social distancing protocols. As always, making arrangements before you come is required, but materials can always be safely dropped off in the front porch mail slot at any time. Of course, some disclaimers. This presentation contains the most current information that we have available, but we are in a very fast-moving environment. We verify all our information and obtain it only from what we believe to be reliable sources. However, much of the information that we use is subject to revision. This presentation is not intended to be used for personal tax or investment advice. Our clients know that we provide such advice routinely. However, when we do, it is in the context of one's financial plan, and we have their financial details in front of us. Lastly, I would like to acknowledge that Kevin and Milt have again received the 5-Star Wealth Management Award for 2020. You make this award possible with your continued support, and for that we are truly grateful. Here's an outline for today's presentation. We would like to give you an update on the advisor client website capabilities, provide a recap of the markets in 2020, review key market indicators, and discuss some important issues for 2021. From an investment perspective, we have never been quite at a point like this one, where so many events could have such a dramatic impact on our investments, negatively or positively. The state of the economy, the pandemic, the unprecedented levels of stimulus, a new administration in Washington, and the list goes on. Interpretations and projections of these events going forward has never been more fraught with uncertainty. In investing, there's never certainty, only probabilities, and your financial plan has never been so important. With that, we have allotted some time at the end of our presentation for Q&A. However, feel free to ask questions using the chat feature at any time. Many participants have sent us questions prior to this call, and we will be sure to answer those questions. Next, Justin will provide you with some advisor client website capabilities.
Thank you, Brianna. As you all know, TD Ameritrade announced in November 2019 that they had agreed to be acquired by Charles Schwab. This will create one of the largest custodians in the industry, rivaling Vanguard and Fidelity. The acquisition closed late last year. However, the transition will take some time, with an integration period estimated to be 18 to 36 months long. We expect your accounts to migrate to the Schwab platform perhaps as early as this year. We will keep you posted as more information becomes available. In the meantime, you can still access your TD Ameritrade accounts online via the website advisorclient.com. As we move into tax season, you may be wanting information from your TD Ameritrade accounts, such as tax statements like 1099s. You can access all this information on Advisor Client, which can be accessed both on a desktop computer or on a mobile browser. There's also an Advisor Client app that you can download on your Apple or Android device. So if you're on a computer, an easy way to get to the advisorclient.com webpage is by going to our website at fullenfinancial.com. And you should see in the top right-hand corner of the page a green button that says Clients. If you click that button, you'll be taken to this page, the client login page, which has a series of shortcuts for websites you might use as a client of ours. So if you scroll down from here, you should see these shortcuts that bring you to the reference websites. Clicking the TD Ameritrade button in the top left corner will bring you to the Advisor Client page, where you'll be prompted to log in, or if you've never accessed the website before, to set up your profile. We will likely need to complete a form called the advisorclient.com access form to link all of your accounts under one sign-in. Just let us know if you need help accessing advisorclient.com and we'll make sure you're squared away. On the Advisor Client website or app, you can review account activity, you can generate and download tax forms such as 1099s, you can link bank accounts, and you can also initiate deposits and withdrawals from the Advisor Client website. For those that prefer doing everything on your phone, you can also download the mobile app. So just go into your app store and search Advisor Client, and you should see the Advisor Client app. It's currently available and free to download on both the Apple Store and the Google Play Store. So one important note, ensure the app that you download says Advisor Client in the name. There's a few other TD Ameritrade apps for other types of TD Ameritrade users, but all Fullen Financial Group clients are on the institutional TD Ameritrade platform, which is accessed via Advisor Client. So you should see in the thumbnail, it should say Advisor Client. So just a tip there. Again, if you have any questions or if you haven't used advisorclient.com before and you want to get set up, feel free to reach out to your associate advisor, myself or Brianna, and we'll make sure you're taken care of. And with that, I'll go ahead and turn it over to Milt, and he's going to go over the 2020 market recap.
Thank you, Justin and Brianna. Before I start my portion of the presentation, I want to acknowledge three very important people who are the backbone of Fullen Financial's strengthening client support capability. This started with the hiring of our associate advisors, Justin Seidenwan and Brianna Stein, and our administrative coordinator, Aigul Jumasheva. In a very difficult environment, they are learning fast and becoming an integral part of our advisory team. Most of you probably know that in 2020, Brianna passed the Certified Financial Planner exam. She is now looking for her next area of focus. You can probably guess that Justin is also preparing for the CFP exam. And Aigul is becoming a master at coordinating the nuances of scheduling and administration in a virtual environment. And all of this was done while we learned how to operate in a pandemic. Consistently increasing our knowledge to support our clients is part of our culture, and these associates are demonstrating that. They are dedicated to helping people better manage their financial lives. Again, I think it's important to acknowledge the contribution these three are making and how much they want to help you. Their actions are consistent with our commitment that learning never stops. It's hard to talk about a 2020 stock market update without addressing a basic question. Are stocks disconnected from the economy? All of us have heard the pundits point out this apparent inconsistency between stock values and the economy. The price-earnings ratio is one variable seemingly to support this inconsistency. That is why I'm starting my 2020 review in a different place than where I usually do, with the price-earnings or PE ratio. The PE ratio for a company is the ratio of the stock price to its earnings per share. The Shiller PE, the one shown here, is one of the better known PE ratios. This one represents the aggregate PE ratio for the companies in the S&P 500 using actual company profits, not projected profits. You can see that the Shiller PE ratio has steadily increased from 2019 through 2020. This is because stock prices have not dropped in proportion to the lower corporate earnings seen in some sectors of the pandemic economy. As you can see, this is the metric is also a metric well above its historical average of 16. So, why do some pundits proclaim the stock market has disconnected from the economy? To gain some insight into this, I'm going to look at the last 4 major market meltdowns because it shows us an important change that has occurred in how governments and central banks, like our Federal Reserve, have responded to the market turmoil. The dot-com bubble bursting primarily impacted sizably overvalued technology stocks that basically had no sustainable business model. While the bursting dragged down the entire stock market, it was temporary. Many of these technology companies just vanished. It is noteworthy that limited Federal Reserve and congressional action regarding the stock movements were applied at that time. How this stock market bubble ultimately burst has implications today. The current highly inflated shares involved in the conflict between market shorters and day traders is already having a similar outcome. The impact on the general investment marketplace has also been similar. We have seen some market volatility. However, stock market bubbles have come and gone throughout history. And while some have taken years to develop, once the bubble pops, the market eventually returns to behavior based on more realistic fundamentals. The impact of 9/11 on the stock market was violent, but short-lived, only a couple of years. Again, there was limited Federal Reserve or congressional action. Next comes the subprime meltdown. This represented a turning point in Federal Reserve and government intervention. These two entities worked in tandem to provide an, at the time, unparalleled level of economic support. Looking back, the stock market recovery completed while the underlying economy was still in recession, which, like today, appears to reflect a major disconnect. Appreciate that my observations are not intended to be an opinion on whether or not such stock support should have been provided. I'm simply pointing out that, at the time, unusually aggressive steps were taken. Now comes the 2020 pandemic. Frankly, the steps we have taken so far make what was done during the subprime meltdown look like child's play. This information provides a backdrop to answer the basic question: has the stock market disconnected from the economy? Before I leave this slide, I want to make one other observation while I have these four events in front of us. During each one of these events, wealth inequality grew. I'll come back to that in a few minutes. The answer to the question, are stocks disconnected from the economy, is actually quite complicated and involves many economic factors. However, I'm going to answer this question focusing on only two of those factors. Let me start by acknowledging that the stock market should represent the present value of future company profits. This requires an estimate of future profits and an assumed interest rate. Once these two factors are identified, company valuation is a simple mathematical calculation. Unfortunately, future profits and interest rates can be the subject of intense debate. Important to note, the stock market is valued based on future events, not current events. As you can see, both profits and interest rates involve predicting the future, which is always subject to controversy. Yet, how you answer these two questions will provide your proof or disproof as to whether the stock market is disconnected from the economy. If you want to prove the stock market is disconnected from the economy, all you have to do is assume that current lower pandemic profits are going to become normal and interest rates are going to soon return to their much higher historical averages. Those two assumptions in the current economy will result in an extremely overvalued stock market. However, you have to ask yourself, are today's lower profits in some sectors permanent? Are the higher profits in some technology companies going to be short-lived? And will interest rates return to their historical levels anytime soon? Most economists don't think so. Many of us might not remember the present value calculations from our school days. So I ask you to remember this. When interest rates go down, the value of just about every asset we own goes up. That includes real estate and stock values. Conversely, when interest rates go up, the value of just about everything we own goes down. Here I have identified some of the significant measures injected into the U.S. economy by Congress and the Federal Reserve to combat the damage done by the pandemic. I refer to these as stock insurance. I realize these actions are meant to lift up the entire economy, not the stock market. However, the stock market is part of the economy. While the stock market benefits of these actions is probably an unintended consequence, unintended or not, it's real, and these are powerful market stimulants. Kevin will revisit these items later. But these are just the headlines. There's more stock insurance being applied than just these. But don't underestimate the staggering scope and influence of these actions. So, has the stock market disconnected from the economy? Not really. But there is no denying that we have introduced new and powerful actions that look to have changed the rules of engagement between the economy and the stock market. We appear to no longer simply let the economy sort itself out. Appreciate again, I'm not saying this is right or wrong. It is simply an observation that we are changing the way one needs to evaluate and interpret the stock market. And for those who try to predict where the stock market is going next, they now have to include Congress and Federal Reserve actions to a degree never seen historically. If beating the stock market was hard before, the degree of difficulty has just been magnified exponentially. With that backdrop, let's look at some of the 2020 investment market statistics. This chart identifies the major asset sectors and shows full year 2019, full year 2020, and Q4 2020 results. Note that inside the box are the basic asset sectors that make up a diversified portfolio. To say the least, 2020 was a very unusual year, with a great deal of real hardship for many and anxiety for all. However, look at the full year 2020. It looks like a reasonably normal year. Not until you see the performance of US REITs and the AMX oil index does it start to look somewhat unusual. I'm going to show another breakout of the full year 2020 in a couple of slides so that we can see just how unusual 2020 was. However, before I leave this slide, I want to make one very important point. Look at the sectors inside the box and compare the full year 2020 and Q4 2020. With the exception of fixed income, every asset sector had the bulk of their 2020 gains in the fourth quarter. In fact, if you miss the fourth quarter gains, you have had a rather mediocre year, and in some asset sectors, probably a negative year. All of us know we had an election in the fourth quarter of 2020. Leading up to that election, many pundits were offering totally logical reasons to exit the stock market investments. Yet the reality is, anyone who withdrew from their investments to avoid the election turmoil would have finished the year with a substantially underperforming portfolio. Depending on when one withdrew through the year, the loss could have been large. You have heard us many times state that successful investing is emotionally very difficult. Frankly, we are not built for this. Add to the fact that we are now seeing extraordinary congressional and Federal Reserve Bank actions that were once only theoretical. We often hear about how risky markets are, and that is absolutely correct, particularly if you are investing short-term money. While investing in the stock market is risky, What some important studies are showing is that it is even more risky to be out of the market with your long-term investments. These studies are showing that investors miss more yield while they are waiting for something to happen than if they had simply remained invested throughout whatever volatility comes along. I will add that having a financial plan is a critical component to determining the amount of funds that you can expose to such risk. Sadly, this is something most investors don't have the benefit of. Now I want to briefly identify what a hypothetical portfolio for 2020 would have produced in yield. For this hypothetical yield, we assume a 35% is invested in fixed income securities and 65% is invested in equities. That 2020 hypothetical return is 10.57%. What your return is will depend on your specific asset allocation. Now, here is a slide that much more clearly identifies what the market sectors did in 2020. What I did was I broke down 2020 into its major components based on the direction the stock market was moving. I included the NASDAQ index as proxy for what technology did in 2020. The first column is the percent yield through February 19th. This is the highest point before the market was impacted by COVID-19. Column 2 is the percent yield from February 19th through March 23rd. This represents 4.5 weeks of sheer terror. We have never had a drop that large, that fast. Column 3 is the percent yield from March 23rd through the end of the year. Like the drop, this recovery is historical in its magnitude. We have never had a recovery from these depths that fast. Keep in mind, as you review these percentages, that the magnitude of the increase required to recover from a drop is substantially higher than the percentage drop itself. In other words, to recover from the average drop of about 35% requires an increase of about 60% to simply get back to the starting point. Column 4 is the percent of the full year 2020. Now I direct you to look at the drop identified in column 2 and compare that to the full year result in column 4. Depending on your specific asset allocation, all Fullen Financial clients ended 2020 with a yield that in some form resembles the aggregated sector yields in column 4. It can be hard to believe that the full year results included the losses from column 2. I now want to expand on my previous reference to wealth inequality. While wealth inequality is caused by several factors, most of which are better suited to be reviewed by people other than us, for Americans who are able to invest in the stock market, a differentiator in wealth accumulation can be found in their stock market portfolio performance. This is the fourth major market crisis since 2000 that we have worked through with our clients. During that time, we have observed a few things. Let me share some of them with you. As I have already said, the dot-com bubble bursting, 9/11, and the subprime meltdown all saw wealth inequality grew through the market drop and subsequent recovery. And now we have the pandemic, which obviously we have not seen the end of yet, and whose investor behavior analytics are not yet available. However, there is tangible evidence that in this pandemic, we are repeating the same investor behaviors that we saw in the first 3 market meltdowns. This time we can even add something new, the day traders versus hedge funds, which in the end will result in even more wealth inequality, particularly for the day traders themselves. While the cause of these calamities were very different, investor behaviors patterns were very similar. Studies of the first three market calamities show that the majority of American investors exited their stock market investments well before the market fully recovered. Conversely, wealthier investors, often supported by their advisors, as a general rule, did not exit the market. I further suspect that most investors who exited their stock market investments had no one other than the popular financial news media or the news media in general on which to base their investment decisions. Sadly, almost none had a financial plan. Consequently, like the prior three market meltdowns, when all the tabulating is done, this pandemic will have widened the wealth inequality even more, possibly a lot more. And worse, the damage done is permanent and compounds through the rest of the investor's life. The investor who missed the column 3 returns will never catch up to the investor who never left the market. Can I give a clear example of why it is risky being out of the market, no matter what your emotions are telling you? Now let me direct you back to the 2020 yields by asset sector as shown in column 4. While Fullen Financial clients have done just fine, our yields will not be the yields received by most Americans. In fact, when all the pandemic analysis investor behavior is completed, most Americans will likely see their returns more closely resemble the returns in column 2, not column 4. My expectation is not based on current research of the pandemic. That's not even available yet. It is based on the analysis that is available about the prior 3 meltdowns. I also ask you not to misinterpret me. We are not through this yet, and there will be more volatility ahead, and some of it could be severe. Now let me turn the presentation over to Kevin to provide a look at 2021.
Thank you, Milt, and good morning, everyone. Appreciate all of you being with us this morning. Wish we could have done this all face-to-face over a nice breakfast, but in any event, as I've done the past couple of years, I want to take you through an outlook for the coming year by reviewing some key economic indicators. But this year in particular, economic indicators alone are not going to tell the whole story. Although 2020 is a year all of us would like to forget, economists and historians will be talking about this past year for a long time to come. It's possible the events of 2020 will spawn more case studies and research papers than any other year in our history, touching on virtually any discipline you can think of. Of course, the pandemic has been the primary driver, but mixed in with that, we've had months of social unrest and a very contentious national election, the results of which will bring lots of changes on the policy front. My goal here is to try to make some sense of all of this in the context of your financial plans and investment portfolios. Before we get into the details, though, I want to spend just a couple more minutes looking at the big picture. We've all been hearing the phrase, the new normal, for a while, and at some point we might be able to determine exactly what that is. But one of the themes of the slides I have today is that we just don't know yet what the new normal will be. I've tried to summarize here some of the key questions that remain outstanding. As I said earlier, the pandemic and how society responded to it will be heavily scrutinized. But one thing we know for sure is that this will not be the last pandemic we'll face. The impact of the next pandemic will depend a lot on the learnings we take away from this one and how that knowledge translates into public health and economic policy going forward. We talked in our town hall meeting a few months ago that some of the behavioral adjustments we've all made in the near term are likely to remain even after the pandemic is under control. This will impact the markets in various ways and may have implications for some of our planning assumptions as well. Other important issues like social justice and climate change came to the forefront in 2020, and we believe these will impact many policy decisions going forward. I'll talk about that a little bit and how the new administration is addressing some of these issues from a policy standpoint. So with that backdrop, I now want to turn to the economic data for 2020 and an outlook for 2021. The first metric we have here is GDP growth. And on this slide, we're showing the year-over-year growth for the past 3 years. It should come as no surprise that GDP turned negative in 2020, but I think we need to look at the quarterly data to get a more accurate picture. Quarterly results in 2020 paint a very similar picture to what Milt showed for 2020 market returns. In the first quarter, GDP was down about 5% from the fourth quarter of 2019, and that was followed by a staggering drop of 31.4% in the second quarter, and then a remarkable comeback in Q3 when GDP rose 33.4%. Final GDP numbers aren't in yet for the fourth quarter, but analysts are estimating growth in the low single digits in Q4. So where does GDP go in 2020? Current estimates say GDP growth here in the US will be around 5% for the full year 2021. However, these estimates may not reflect the recent surge in the virus and resulting mitigation efforts. At the global level, the International Monetary Fund recently raised its GDP growth estimate to about 5.5%, but warned that new strains of the COVID-19 virus could negatively impact this estimate. Although the overall growth rate is promising, we're likely to see vast disparities among regions and even from country to country, depending on those countries' success with mitigation efforts and vaccine rollouts. This will mean that certain sectors of the economy, such as travel, will still face significant challenges this year, and supply chain disruption could continue to be a risk in certain industries. Now let's move to consumer confidence, and here you can also see a large negative impact in 2020. We know that consumer confidence is a fickle thing and can change quickly and drastically. And we also know that the consumer sector drives about 70% of US GDP. So it's an important metric for overall economic health. The good news here is that although consumers' confidence about their current situation declined in December, their expectations for the future actually improved. And we've seen a continuation of this trend in January as well. Clearly, progress against COVID-19 will be a key driver of this metric. And we actually believe that if vaccination efforts are successful, we could see a real surge in consumer demand in the latter part of 2021. And I'll talk about this a little bit more when we look at consumer prices and inflation. One metric that is perhaps a bit surprising is the Investor Confidence Index, which ended above the baseline of 100 in December 2020, after being down in the low 70s earlier in the year. If you recall from last year, this metric is not based on a subjective survey, but it's derived from actual trading patterns among institutional investors. The more of their portfolios these investors allocate to risky securities, the higher this confidence metric will go. There's not a lot of real-time data on how much of the market is held by institutional investors, but estimates range from about 67% for the market as a whole, up to as much as 80% for large cap companies in the US. So clearly their trading behavior carries a lot of weight. As Milt said earlier, investors value equities not based on what is happening right now, but on what they expect will happen in the future. So this indicates that investors are cautiously optimistic about equities and how they might perform going forward. Now let's look at unemployment and labor market participation. The increase in the unemployment rate last year is certainly no surprise, but like many of these metrics, the year-end number really doesn't tell the whole story. The unemployment rate was still at record lows, around 3.5% in February of 2020. But by the end of April, unemployment stood at, again, a staggering 14.8%, and it stayed above 10% until August. Similarly, the labor participation rate hit a high of 63.3% in February and a low point of 60.2% in April. Although we don't have empirical evidence on this, it seems reasonable to believe that ongoing school closures have had some impact on labor participation if parents are unable to work outside the home. Older workers as well were more likely to leave the workforce due to heightened risks with the virus. Interestingly, if the vaccine rollout is successful and schools reopen, a surge of workers back into the labor force later this year, all looking for work, could mean that the unemployment rate remains stubbornly high for some time to come. Now I want to look at inflation, which we also refer to as the Consumer Price Index, or CPI. Although the inflation rate is down overall in 2020, some components of the metric, primarily food, rose significantly as a result of the pandemic. One interesting point I want to make about inflation is the possibility that it could rise above the levels we've seen over the past few years as we come out of the pandemic. Fed monetary policy continues to be very stimulative. The federal government has pumped trillions of dollars of stimulus into the economy, including cash payments to most taxpayers, whether they truly needed the money or not. And consumer demand has been suppressed for close to a year. If we see a significant surge in demand in the second half of this year, and if supply chains are not fully ramped back up at that point, we could very well see a meaningful uptick in prices. Most economists believe, however, that any inflation we see is likely to be short-lived, perhaps a year or two, and then longer-term inflation will be more in line with recent history. Now, I want to talk for a minute about monetary policy and specifically the Fed funds rate. As we've discussed in the past, the Fed uses monetary policy primarily as a tool to maintain balance between the unemployment rate and the rate of inflation. We started 2020 at the same rate we saw at the end of 2019, around 1.5%. And the rate stayed above 1% into March, but then came down effectively to 0 in April. We've essentially remained at that level ever since, and the rate has not really changed as we've moved through January. Remember, though, that the Fed funds rate is not the only policy tool they've used during this pandemic. As Milt touched on earlier, the Fed employed much of the same monetary stimulus in 2020 that they did in the Great Recession in 2008 and 2009, and included some new programs in 2020, like the purchase of corporate bonds that we really hadn't seen before. And interestingly, despite all of these efforts, combined with several $1 trillion of fiscal stimulus, the Fed is still quite cautious in its outlook for the economic recovery and expects rates to stay low for some time to come. I want to make just a couple of points about longer term rates as well, which continued to come down significantly in 2020. The first point is that mortgage rates are an important component of long-term interest rates, and they currently hover around 2.7% for a 30-year fixed rate mortgage. This is having a very positive impact on the housing market, which does have a multiplier effect in the economy. In fact, this is one area where people have spent significantly during the pandemic, not just to relocate away from densely populated urban areas, but also to improve their existing homes where they now spend so much more of their time. The second point is, and this picks up on a point that Milt made earlier, we continue to see significant inflation in a couple of asset types, namely housing and the stock market. Both of these can be tied directly to lower long-term interest rates. Those who own a home or invest in the markets are benefiting from this inflation. But for those who are not homeowners, who don't have investment portfolios, and who aren't seeing meaningful growth in wages, it is becoming more and more difficult for them to accumulate wealth. And as Milt said, the reasons for the wealth disparity in our country are better explained by others, but the reality is that this has transpired over many decades, and the gap is not something that can be closed quickly or completely. But recognizing the impact government policy has on this issue and balancing that appropriately with other important policy objectives is a huge part of that challenge. And I do want to spend a minute this year on another important impact of these low interest rates. This is not something we've looked at in this level of detail before, but I want to talk about the government's continued willingness to borrow enormous sums of money. As you can see on this chart, national debt as of September 2020 was a record $26.9 trillion, an increase of almost $4 trillion from the prior year. And keep in mind, this does not include the current $1.9 trillion proposal working its way through Congress. National debt as a percentage of GDP has increased by 30 points over the prior year. And the last time it was at this level was in 1946, as we were just coming out of World War II and the country was in the midst of a recession. Of course, the national debt has been growing steadily for decades. Much of the increase is driven by demographics, as the baby boom generation ages and utilizes entitlement programs to a greater extent. But the continued expansion of the federal government, combined with ongoing wars in the Middle East and significant tax cuts in 2017, have also played a big role. So with that context, I want to spend a few minutes talking about two policy areas for the Biden administration that will impact these debt levels. The first is the proposed stimulus plan I mentioned a minute ago. And on this slide, you can see the primary components of the plan, all of which are designed to offset the ongoing impacts of the pandemic. As we mentioned earlier, the CARES Act was a $2 trillion plus stimulus program that was passed early in the pandemic. And there was another $900 billion of spending that was approved late in 2020. This new plan could bring total pandemic-related fiscal spending to more than $5 trillion, which is about 6 times the amount that was spent during the Great Recession in 2008 and 2009. And when you look at these debt and spending numbers, it's reasonable to ask, how long can this continue? And what might the government do differently if faced with this situation again? Now, the new administration has also proposed some tax policy changes, and I've tried to summarize those here. As we all know, there are really 2 ways to reduce a budget deficit. One is to reduce spending, and the other is to bring in more income. This applies to the federal government the same way it applies to all of us. On the spending side, the government's flexibility to reduce the deficit is actually quite low due to entitlement programs, defense spending, and interest on the national debt. And remember, the government has been able to borrow at near zero interest rates during the pandemic. Any meaningful increase in those rates will limit that spending flexibility even further. So clearly some work needs to be done on the revenue side. And all the items on this list, except for number 5, will help address the deficit spending and debt levels I've been talking about. And not surprisingly, many of these will have negative impacts for higher earners and those with significant wealth, which is only logical because that's really where the opportunity is. Now, as you know, we tend to plan based on what we know about taxes, not what we think might happen. As these proposals move through the legislative process, though, we'll continue to monitor any changes and revise our recommendations and guidance accordingly. So let me try to tie all of this together and relate it back to your plans and your investment portfolios. In our breakfast meeting last year, we predicted continued market volatility in 2020, although obviously at that time we had no idea just how severe that volatility would be. But I think it's safe to say, as we enter 2021, we enter the year with even more unanswered questions than we had at this time last year. Despite all that happened in 2020, as Milt showed earlier, the markets actually performed quite well, although supported by massive amounts of government stimulus and heroic efforts in healthcare and vaccine development. But given where stock values are today, the market is expecting continued progress on vaccine distribution and potentially another large stimulus package. Only time will tell if events will unfold as expected. Keep in mind, though, that markets crave stability, and stock values are based on future expectations. When actual events differ from those expectations, that causes volatility in the markets. So the year ahead is likely to see continued volatility as these questions are answered and new questions continue to arise. So here's our message for you for 2021, and this will sound very similar to our messages in prior years. There will be temptation to react to short-term market movements, and we're going to do our best to prevent you from doing that. We've developed an allocation strategy for each of you that fits your particular financial circumstances, your goals, and your time horizon, as reflected in your financial plan. Your portfolios are designed to withstand short-term market downturns because we have a good idea of when you're going to need that money, and we've allocated your assets accordingly. And your plan results assume a certain rate of return for your assets. And that assumption is tied directly to your allocation strategy. If we start to change that strategy in response to short-term market movements or our expectations for those movements, the rate of return assumptions in your plan become less reliable. As I mentioned a minute ago, although we don't advocate reacting to short-term market movements, one important part of our job is to filter through these events and determine how they might impact key assumptions in your financial plans, including rate of return assumptions for your investments, as well as the various tax strategies we've developed. As we identify and monitor those issues, we will discuss them with you as part of the plan review process and make changes to your plans if necessary. So it looks like the bumpy ride will continue this year, but in that type of environment, keeping a level head and sticking with a financial plan will continue to serve you well. If any of you want to discuss the issues here in more detail in the context of your own plan, feel free to contact us by phone or email. And that wraps up the presentation. At this time, I will turn it back over to Brianna to take us through some Q&A.
Thank you, Kevin. We will now open the floor to questions. You may ask your questions using the chat feature in the lower middle of your screen. We did have some questions sent to us prior to this call, so we will begin by answering some of those questions. Let's see. First, Kevin, maybe you can just keep going and hit this one. Will the ongoing tension between hedge funds and day traders, like we saw with the GameStop recently, have any impact on our portfolios? It looks like Kevin disappeared.
I think we lost Kevin. I'll tell you what, why don't we switch to a couple of the questions that I raised my hand for. So
okay.
I'm sure Kevin will return.
Yeah. Okay, Milt, let's start with this one. Where can we invest to offset the current low interest rates?
Okay, low interest rates are difficult for many people. It's a two-edged sword, actually. If you're a credit seeker borrowing money for a home or financing debt, able to invest in equities or your business, the current low rates are a bonanza, an unexpected bonanza, quite frankly. On the other hand, if you are living on a fixed income, this can be a very difficult situation. Perhaps one of the most famous investors of all time, Warren Buffett, has cautioned several times recently, cautioned investors against increasing their risk to chase yield. Even if it might work for a while, it has a high potential to end very badly. Unfortunately, when it ends badly, there are limits as to whether the damage can even be undone. Claims that seem to point to a new or better approach are always misleading and generally involve complex products based on opaque algorithms. Maybe it helps to keep one point in mind. Everyone is investing in basically the same asset pools. Think about it. The mere fact that you read something that means many people reviewed it before and the market would already have adjusted. There's no magic bullets here. The best solution available is to maintain your asset diversification consistent with your financial plan.
Okay, Kevin, it looks like you're back. So,
yeah, sorry, I don't know what happened there. I just kind of dropped off.
No worries. Will the ongoing tension between hedge funds and day traders, like we saw with the GameStop recently, have any impact on our portfolio? That's the question again.
Thank you. Yeah, this is an interesting one, and certainly the recent episode with GameStop has been fascinating to watch. But we don't really believe that these kind of things will have an impact on your investing portfolios, and there's several reasons for that. Before I get into that, though, I just want to do my best to recap what's actually been going on. Hedge funds frequently engage in what's known as short selling. And that's a practice of borrowing shares to be sold at some point in the future at a predetermined price. The short sellers are anticipating that the share price will go down before that date, meaning that they can purchase the shares at a price lower than the agreed upon sale price and therefore make a profit. GameStop was a company that had been shorted by a number of investors because the fundamentals of their business were viewed as being pretty weak. And there was a view that the stock price was likely to go down. But then for some unknown reason, the online group called Wall Street Bets, among others, started to encourage its followers to buy shares of GameStop. It was almost like a crowdfunding campaign on Reddit. And the sole purpose was really to drive up the price of GameStop, which could potentially result in huge losses for the hedge funds and anyone else who had shorted the stock. It's what's known as a short squeeze, and it actually worked pretty effectively in this case. But what happened, though, was that several retail trading platforms at that point restricted trading of GameStop shares. And this allowed investors to liquidate their positions, but did not allow anybody to buy additional shares. So this was sort of a safety valve at that point for those who had sold short. And it was actually a rather controversial move in the eyes of a lot of market participants. But again, as I said, we don't really think this type of activity will have a significant impact on your portfolios. And the first reason for that is that, this type of activity tends to be limited to much smaller companies, companies that are not heavily traded. And in fact, in some cases, they might not even be listed on a stock exchange. The vast majority of companies that we invest in would not be susceptible to an event like this because they're too large and their trading volumes are too high. That's not to say that it's impossible, but we think it's pretty unlikely. The second thing is, as you all know, we focus a lot on diversification, and we diversify your portfolios broadly across asset classes and within asset classes. And so even if a handful of companies were to be targeted in this fashion, it's unlikely to have a meaningful impact on overall portfolio performance. And then the last reason, and perhaps most importantly, the type of behavior we saw with GameStop rarely changes the intrinsic value of the stock. And we're actually seeing this play out here over the last couple of days. Once all the drama runs its course, the stock always or almost always returns to the value that's derived from expectations for future cash flows, as we talked about earlier. In fact, one of the tragic consequences of this episode is that so many of these short-term traders are going to be left holding a stock that's significantly overvalued. But those folks who invest more strategically, like our clients do, they really won't be impacted by these kind of artificial swings in price. Now, there is one other point I want to make, and that is, what we saw with GameStop, where these large groups of retail investors are kind of engaged in this coordinated buying activity with the express purpose of, squeezing the short sellers. This is a relatively new phenomenon. And we don't really know where this practice might go from here, or if there will be any sort of regulatory response to this type of activity. So it is something that we'll have to keep an eye on going forward and see how it develops.
Great. Someone just asked, will a recording of today's presentation be available to clients? Yes, we will send that out to you. Let's see, let's look at the next question. Milt, maybe you can take this one. With all of the 2021 headwinds, are there any positives?
The answer to that question is sort of an unequivocal yes. This is an important question, and we hear it a lot, especially in times of volatility. And it's particularly relevant. We're dealing with a pandemic that has brought the world as we know it to a halt, and many people have lost their loved ones and their livelihoods. And yet, in all this pain, there are positive side effects inside this catastrophe. And that may seem very unusual, but when we face experiences like this, we tend to do things, accept things, allow things that under ordinary circumstances we would probably be reluctant to do. This is probably easiest seen in the search for a vaccine, starting with the Chinese who managed who mapped the virus's genome, and they shared it with the rest of the world. Academic research done by a Hungarian immigrant at Penn State, and applied research done by Turkish immigrants in Germany. Many people may have heard BioNTech's name as a partner with Pfizer. That's the company I'm referring to. And this information flowed freely, unrestricted by tariffs, unrestricted by trade restraints. And that information brought us a vaccine in a time frame that we've never seen before. Research and development in the private sector is now at a 10 to 15-year high. Governments are also looking to rejoin the R&D process, possibly at levels not seen for years. Telemedicine, which was resisted by the medical community, regulators, and ordinary citizens, now has the potential to become commonplace and perhaps help address one of America's most pressing problems, the high cost of healthcare. Self-driving car technology, after a few years of seemingly being dormant, is roaring back to life, supported heavily by many agreements between IT and car manufacturers, and many of these agreements are cross-border. And here's why this matters. There is a reason it matters. I lost my screen. Productivity is the source of real wealth, and it benefits everyone. Economists have been pointing out for 40 years that every time we have come out of a serious economic pullback, the productivity increases that we have seen are getting smaller and smaller. If we can maintain some of the lessons learned during the pandemic about how to really leverage technology, work together, and compete fairly inside a less tangled global system, that evidence that that provides evidence that real productivity gains are possible. Adding to this, there is also an enormous amount of pent-up demand along with capacity to spend. According to the Federal Reserve Bank of New York, over 70% of stimulus payment money received by Americans from the March 2020 CARES Act was either put into savings or used to pay down debt. How ironic that perhaps hiding among the turmoil and suffering exist the elements of a spending tsunami when this virus is brought under control. Collectively, these represent positives that we haven't seen for years. That's all I have to say.
Okay. Kevin, can you address possible investment options and or strategies toward green energy technologies and socially conscious ESG funds?
Sure. And this is another important topic and certainly one that has a lot of different angles to it. But for those of you who aren't familiar with the ESG movement, ESG stands for environmental, social, and governance. And ESG funds direct investments toward companies that score higher than their peer companies on one or more of these metrics. The environmental metric, for example, to issues like climate change, pollution, water security, and so forth. Social focuses on things like human rights, labor standards, health and safety, etc. And governance refers to corporate policies like diversity, anti-corruption, and risk management. The amount of money that's currently invested in ESG funds is growing rapidly, particularly in Europe. And it reached about $1.7 trillion at the end of 2020. That's a big number, but it is still less than 2% of global assets under management. Now, we at Fullen Financial really believe that socially conscious investing is a positive development and one that will continue to grow rapidly. It's already had a significant impact on corporate behavior, company strategy, investment decisions, and so forth. With respect to ESG funds, however, there's some important issues that we think investors should consider before deciding whether to include them in their portfolios. First of all, the criteria for defining an ESG fund is not standardized. And currently there are no regulations governing what qualifies as an ESG fund. So this sort of leaves it up to the individual fund managers to determine their own measurement criteria, and it makes it difficult to compare one fund to another without doing a lot of research. Secondly, the vast majority of ESG funds are actively managed, which likely means that they're more expensive than and not as diverse as a typical index fund. There are some ESG index funds that are available at lower cost, but because they're also very broadly diversified, it's difficult for them to score much better on the ESG metrics than a regular index fund. A third issue is, and this is maybe not as obvious to a lot of folks, but is that a company might score well enough on one of the three criteria to be included in an ESG fund, but they may raise concerns in other areas. For example, many ESG funds right now are invested heavily in technology companies. And technology companies do score well on environmental metrics as a general rule. They promote diverse workforces, but they also face significant concerns about antitrust issues, privacy, censorship in places like China. So those are all factors that need to be considered. Now, it is possible to invest specifically in a green energy fund, for example, to be more environmentally conscious. There's certainly plenty of those type of funds out there as well. We would just want to avoid a scenario where your portfolio is overly concentrated in a narrow sector of the economy, particularly one that's been heavily subsidized by the federal government and could see those subsidies diminish over time. So really the bottom line for us is we think socially conscious investing is an important movement. And we really believe many companies have already been pushed to improve in these areas by their investors, by their customers, by their employees. We're not at this time strong advocates of ESG funds, but we're happy to work with our clients on these if you feel strongly about these issues. We just want to make sure that we know what we're investing in and that we stay mindful of our diversification and our cost management objectives. So certainly, you know, if this is something anyone wants to discuss further, feel free to give us a call, or we can talk about it at our next annual review meeting.
Thanks, Kevin. I think that's all we have for you today. I guess we can stay on a couple minutes to see if anything comes into the chat window. But other than that, have a good day.
Thank you very much.